Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. This is part 2 of my weekly stock market update. Please stay tuned and I'll share with you some charts about the Dow Jones Industrial Average, the S&P 500, and a few industry sectors that I find interesting at this time. But I definitely want to share with you the current state of the S&P 500. From a technical standpoint, the S&P 500, as I said in part 1 of this video, the S&P has never been this overvalued except for last year, 2018. We came off the overvaluation pretty harsh the the fourth quarter of 2019, but because this post-Christmas rally, we are right back up there again at near all-time high valuations, and frankly, last year and this year, we are more overvalued in the S&P than we've ever been in recorded history, going back to at least 1928. So that's my word of caution when it comes to investing. You want to buy investments when valuations are cheap, not at all-time 80-year highs. There are other places to put your money. Not all stock indexes are at stratospheric elevated levels. You just need to know where to look, and as I like to say, if I can help you with your IRAs, your 401k, your mutual funds or stocks, please give me a call. I would really enjoy talking with you and getting to know your particular situation. So you can find my information on this social media site or on my website, as well as at the end of this video. You can find my phone number and email address and reach me there. I hope you do. I would really enjoy getting to know you. And let's go ahead and talk about the S&P 500, and we'll look at that chart. But briefly, I'll say that the S&P is extremely overbought. We've only been this overbought in probably 4 times in the last several years. Overbought means that the buying enthusiasm for stocks is getting extremely burned out, getting very tired. If you go up too fast in a stock market index, you just simply run out of gas. Think of the stock market as a living creature or a marathon runner. He runs, or I should say a marathon sprinter. If a man or woman sprints really hard, eventually they run out of gas and just have to stop and rest a while. Well, the stock market's just about the same. It's sprinted really hard and fast and broken some records since Christmas. It needs a rest, a pullback, or a pause, and we just need to wait and see what happens. So we are technically overbought to the extremes, which I'll show you in a moment, but we are also in a rising bearish wedge pattern on this S&P 500, which, if it does play out, should resolve to the downside, and we'll just see how much of a downside that turns out to be. I kind of think that we should go down and check out those Christmas 2018 lows, which would really, really worry a lot of investors, because that would be a 15 to 20% drop all over again. And right now everybody thinks that everything is wonderful and calm and the bull market is here again. So all right, let's go ahead and jump into the charts. I'll begin with the Dow Jones Industrial Average and then the S&P 500. Take a look. Here is an 18-month chart of the Dow Jones Industrial Average. You can see it's been quite a ride for the last 18 months, and we're pretty much sitting right where we were in January of 2018. However, we have not been able to stay above the high of November 2018. We popped back above it, and now we're right back below it again. And we haven't gotten back to all-time highs, or we haven't gotten above the January 2018 high. So it's still just kind of struggling up here for the last about month and a half, trying to figure out whether or not it wants to go higher or go back down. A couple things that are a slight concern to me, and that is the current trend line since Christmas. Let me go ahead and draw that in. I went ahead and made some changes real quick. I switched the chart to a candlestick chart, which is why this is not just a simple line. It shows the high, low, open, and closing price of each trading day. And I changed the chart to a 1-year chart instead of an 18-month chart, just so it was a little bit easier to see. But if you draw a line from the lows here of the day after Christmas, December 26th, and you draw it up and connect it with the low right here of March 27th, you can see that we're sitting on it right now as of April 10th. We came down and the low of the day today was essentially right on that blue line. So I'm waiting to see if this trend line since Christmas breaks, and if it does, I would guess that we're also going to fill this gap right here, which I'll highlight in a red circle. This red circle here on the Dow Jones chart is sitting there wide open between the last day of March and the first day of April, and on the Dow Jones and S&P 500 and Nasdaq charts, gaps are filled 93% of the time, which means that when there is a gap to the upside, typically the index will come back down low enough to fill the gap, and then it can go higher or lower from there. Right now it's just kind of floating up here. We've had about 2 weeks of sideways movement in a little bit of an island, disconnected from the rest of the chart. You can see on this chart that there are no unfilled gaps. So, well, there's one right here that could get filled at some point, but it's just hanging out there in January. I would guess that it will get filled sometime in the not too distant future, but we won't speculate on that any further. But this gap right here is not very far away, and I would guess that the Dow Jones will move its way down over the remainder of April and at least fill that gap, which will also be a slight problem because it'll break this blue trend line since Christmas, and we'll see if it opens the door to much lower prices in the Dow Jones Industrial Average. I don't know what the catalyst would be other than more geopolitical tensions or trade war stuff, but I would guess that we're probably going to drop just a little bit, enough to fill that gap, and then we'll just see if we, like I said, go lower. This Dow Jones Industrial Average could drop probably 5 to 7%. Let's see how much it would likely be based on an estimate. These blue lines that I drew in here, those are called Fibonacci retracement lines and are often used as an estimate of where a stock or stock index could pull back to in a normal fashion. In a bull market, you typically can pull back to this first line here, also known as the 38.2% line. And if we do pull back to that, which again would be absolutely normal, it would coincidentally fill that gap right there that I just talked to you about at the end of January. The top of that gap, or I should say the bottom of the gap, is exactly at the 38.2% line. And if we do that, you are looking at a probable pullback of the Dow of 6.8% to 7% approximately. The calculation is 6.8. So a 6.8% drop, or about, I think it was 1,800 points on the Dow Jones Industrial Average, would kind of make investors nervous. And if it makes them nervous enough, it could drop down to this other line right here, the 50%. And if we're in a bear market still, and this market rallied on no strength whatsoever, we could go back to the 61.8 or all the way down to the Christmas lows. So we got to take it one at a time. But I would say the Dow is probably going to have a 6.8% pullback to fill both of those gaps, and then we'll just cross the next bridge when we get there. So right now would be a great time to take a little bit of stock allocation out of your portfolio and put it into something a little less risky and maybe a little more preservation minded. Here is a one-year chart of the S&P 500, and again, this is a candlestick chart showing the high, low, open, and closing price of each trading day since April of 2018. And we got a couple things here that are concerning. We also have the gap in the chart, just like the Dow Jones had, but I don't see one down here from January, so only the Dow has that one. But this little gap right here between the last day of March and the first day of April still remains open. I think that'll be filled. But what the S&P 500 has is a couple bearish rising wedge patterns, which If they do resolve to the downside, that could open up the door for like about a 7% drop or so for the S&P 500. Let me go ahead and draw those in for you. This is the first or biggest rising wedge pattern that we had since the December downdraft, and it's a pretty big one, to say the least. If this does break to the downside, then I'll draw in some Fibonacci lines to give you a sense of how much it could break percentage terms. But right now you can see we're getting very close to the end of this apex on this triangle, and we're starting to run out of gas a little bit on the stock market. There's also a small rising wedge, which I'll draw in right here. This is just the smaller wedge within the larger wedge, and it just means that we've got two wedges acting against the market right now, and over the next few days we could easily see a retest of this bottom red line, which is support, and if we break that, then we could, like I said, come down to some of these lower levels. Let's go ahead and take a look at what is a likely correction in this market using the Fibonacci retracement lines. Here they are right here in these red horizontal lines. If this is a normal bull market uptrend for the S&P 500, and this happens to be the top of that uptrend for the moment, we could easily have a pullback to this first line right here that says 38.2%. That's not how much we'd pull back, but that just means that we would pull back that amount of the total move, which would be a drop for the S&P 500 of about 7.2%. So again, if this is a good, healthy, bullish uptrend, a pullback of 7% would be absolutely normal. However, people have kind of gotten used to this post-Christmas rally, so a 7% drop may get them a little worried, a little anxious, and we'll see if it causes a little bit more selling in the stock market. But right now, that is what I would expect, is at least a 7% pullback, which means it wouldn't hurt to take a little bit of stock exposure off the table for a little while, and maybe let that play out and see if you can find an opportunity to get in at lower prices, or stay out altogether if in fact we do go all the way back down 15 to 20% to those Christmas lows on this S&P 500. My last chart of the day is the Nasdaq 100 stock index, which is heavily loaded with technology stocks, and this one has been the biggest mover of all three of the indexes since Christmas. This thing has just been screaming to the upside, and coincidentally, I talked about gaps earlier. Well, there is a gap right here at the top back of the first week of October. Let me draw it in for you. I told you that gaps get filled 93% of the time. Well, there is a little tiny gap up there between October 3rd and 4th, I think it is. Let me take a look. 3rd and 4th, yeah. And we are just about ready to fill that gap. All it takes is basically one more day. We might even pull it off tomorrow. But I would be absolutely stunned if we got up there, filled that gap, and that was it for the Nasdaq 100. Early at the introduction of this video, I said that the S&P 500 was more overvalued than it's been in years. That was incorrect. That has backed off on the S&P, and it's not as overbought. It's the Nasdaq 100 that I was referring to. And to show you that, I would like to introduce you to the price momentum oscillator really quick, and I'll add that to this chart. This is the same chart, the Nasdaq 100, but over a 5-year period, and below it I've put in these red and black lines, which are the price momentum oscillator. And the price momentum oscillator is partially used to examine how overbought a particular investment or an index is. And when I say overbought, it just means how likely is it that the buying pressure, or the buyers of that particular index, how likely is it that they are exhausted and that particular chart is ready for a turnaround to the downside or to the upside. In this case, we've been on this huge rally since Christmas, and you can see the price momentum oscillator right here has just exploded to the upside. And all I wanted to point out is that if you draw a line all the way across from where we are, we have only been this overbought or tired, exhausted, 3 times. This much, that is, 3 times in the last 5 years. One was right here, November of 2015, right before the stock market dropped 10% on the Nasdaq 100. The other one was right here, January of 2018, right before the Nasdaq dropped about 10% as well. And now we're right back up there at those same extremes. So we are getting very, very tired when it comes to buying enthusiasm. So I would expect sometime soon a turn to the downside for the Nasdaq 100, and then you'll have one of these situations where the red and black lines curl over and head down to either the midpoint, which is the 0 line, which seems to be pretty common for much of the last 5 years. The 0 line is a area of stability or support, but we need some sort of decompression in this particular chart, either a pullback of 7 or 8% or just a long multi-month sideways move. I think it would probably be likely that we'd get that 8% pullback in the Nasdaq 100. And there's one last chart to support that theory, and I'll show that to you right now. This is a chart provided by Bank of America Merrill Lynch Global Investment Strategy. This is their EPFR Global Stock Index regarding how much money at Bank of America Merrill Lynch is flowing into or out of technology investments at that company. Since early 2017, you can see we went from about a minus $5 billion to a positive $30 billion. So that means that there was about $35 billion that flowed into technology investments or stocks, technology stocks at Bank of America Merrill Lynch. And since the middle of 2018, you can see that redemptions or outflows of technology investments have taken this line almost back down to 0. It's about 2.5 right now, and it was at 30 billion. So, as I said before, with the Nasdaq 100 overweight in technology stocks and flirting with all-time highs, if this chart has anything to do with the Nasdaq, I would suspect that this massive outflow of technology money is going to catch up to the Nasdaq 100 in the not too distant future. So use this as a indication of caution, or a warning in that case, and I would say now would be a good time to use what I've shared with you to maybe put some of your stock investments into something a little less risky, a little bit more preservation minded, and just wait for the next few weeks and months to play out, and maybe you'll avoid another 15 to 20% drop, or you might just find yourself given a better opportunity to buy in sometime down the road later this year. Thank you again for watching. I wish you a very enjoyable week ahead. We'll see where this market goes for the rest of April, but like I said, please don't hesitate to call if you have a 401k and you're not getting enough advice or no advice at all, and perhaps you just have that 800 number on your 401k statement from your plan administrator, and that's all you have. If you want an actual person to help you work toward your financial goals and your investment objectives, I'd like to chat with you a little bit about that. So you can find my number at the end of this video, or on this social media page, or on my website at christensenwealth.com. Thanks again for watching, and remember, getting back to even is not an investment strategy. Yes, the stock market always comes back and has for hundreds of years, but the time you waste by going down with the bear market and then trying to get back to even, that time you've lost never comes back. So try your best to protect on the downside. Thanks. Have a great day. Bye-bye.